Welcome to another market update. I hope you are enjoying the cool weather we're having the last few days here in DFW. I do this as much as possible just to keep you informed on what's happening in the market. Make sure you have the tools to get a pulse and have a pulse of what's happening with interest rates and any new changes that are coming in our industry or programs we may have that will help you make the best decisions possible. I know everything's more expensive right now. Prices are up on homes, interest rates are up, things are more expensive everywhere. So I know it's important to make sure you're clear on the numbers and are always really on the leading edge of what's happening so you can be smart about the purchase and feel comfortable and confident that you're doing something right for your family. I get that completely, and so hopefully this is helpful for you. If you didn't watch last week's video, we did talk about the Cash Plus program a little bit, which we're going to be taking many of you through to see if you qualify for it. It's basically an opportunity for us to be able to offer cash for the property for you to make you more competitive, whether you have a departure home that you don't want to sell first or you are a first-time buyer. So there's more details there. We're going to be sending you some links for some webinars to join to find out more about that as well. Anything we can do to help you be more competitive, and we'll be taking you through that process over the next couple of weeks too. It's going to be a tough summer. It's going to be a good summer. There's going to be a lot of competition, and we want to help you armed and do everything we can to help you win. So here is the quick market update. Remember, this is the mortgage-backed security price chart. If you have a Trading View account, you can get this. If not, it's hard to get this. It's an inverse relationship with rates. So the lower the price, the higher the rates, and vice versa. Red is bad. Obviously, green is good. So the prices really, since October, as we know, have just fallen off of a cliff. If we zoom out a little bit, you kind of really see that pictured better. And we are down in this range here. Now, the good news in the short term is we have come up above some very important support here. We opened above this Fibonacci support level right here. So, and we closed above it yesterday, if you can zoom in on that. We've been in this range for weeks and not been able to break above this. And now that we have, we've got some room to the upside here for a short-term rally that we may be able to help you take advantage of. If you don't have a contract now, most of that's going to, which most of you don't, you're going to be hopeful that this continues until you do find a contract, get an offer accepted on a home. But we'll be watching this in the short term. We still are in a bear market. Remember, inflation is the arch enemy of bonds. And so you have to assume it's going to continue in the downward escalator motion, but we may get some relief rallies, and this looks like one of them in the short term. So that's some good news. Also, hopefully some good news just historically, because I know rates, we all know rates have gone up 2.5% since the beginning of the year. And they went from the high twos, low threes to the mid fives. It's important to kind of have context, right, for what you're looking at. So this, since 1975, this has been tracking rates. 9, obviously we know about the S&L. With Volcker really shutting down the market, right, doing a reboot of the economy, forced interest rates up, and we've been coming down really ever since. So, and if you look, right now, this goes to the end of 2021. They don't have it for 2022 yet. This is where we're at the low, right? Sub 3%. And now we are back up really right above this range here in this, the low to mid 5% range nationwide. So we're really right back where we were in 2009 and 2011 and really 2019. So this is still some of the lowest rates we've seen in the last 50 years. So hopefully that helps you know that like you missed the boat. Now, in situations like this, there are better opportunities in the next 2 to 5 years to have little refinance opportunities because of the way economic cycles work. And when you go into recessions, when it looks like we'll go into, we won't know until after you're out of it, right? Because it's 2 consecutive quarters of negative GDP growth, and you don't know you're in a recession until it's officially, you're out of it. But that's usually interest rates go down a little bit. Unfortunately, you don't know from what levels, right? So they are trending up, and prices are still going up, right? Especially in DFW, because we're one of the hottest places to live in the country. So if you can find a home that makes sense for you before the middle of the summer when everybody gets desperate and has to close before the school year, you're going to be better for it, right? But you're still in a good opportunity overall to find and buy a home. I hope that's helpful for you. Remember, the tool FreddieMac.com is a great non-marketing site that actually tracks all the locked rates every day. They're one of the agencies, right? That's where you securitize. They're the GSE, the agencies that everybody's got to follow their rules and Fannie Mae's rules. So they actually track the locked rates for 760 credit score borrowers with 20% down or more all across the country every day, and then every week they average those, because all money comes from the same place, and the bond market and rates move all day, every day, just like the stock market. So right now, the national average is 5.25 with almost a point paid. In Texas, you got higher property taxes, title policies, and interest rates, because how we securitize, no real estate tax on the sale of real estate, no state income tax, all those kinds of things. So roughly about 5.5 in Texas, real rates with a point. Again, on the weekly average. It's actually going to be a little lower than that now, because this was from last Thursday, which actually was tracking rates that were locked in this range. So you're about an eighth better today than that average. But this is how you can go check to keep a pulse on what's really going on without having to be, all the misinformation and TV ads, radio ads, and all that stuff. This is the real deal. So you can just kind of see if this is going higher. You kind of know what rates are doing. If you see it going lower, you know that's going a little bit lower. So again, I hope that's helpful for you, a tool for you. Then finally, let's go over this cost of waiting here. This is important because I want you to look at this, because we've been talking about this for years. I'm going to show you a few analysis here. Back in 2020, we did this, the buy now in June. At June 2020, rates were around 2.75. We were doing some estimates then, and we were thinking that rates were thinking rates were going to go up to about 3.5%, looking at all the data by the end of that year, right? And prices were going up. So the analysis then showed, hey, if you waited till the end of the year, you'd be paying $330 for that same $300,000 home, and you'd have a 3.5% rate, right? Which meant to keep the same payment as you were getting in June of that year, around $1,876 a month, you would have to buy about $45,000 less house. $285 would be your purchasing power to keep payments the same, right, at those rates. So I hope that helps you. That's what we were estimating, right, that year, because that's what this is all about, right? As rates go up and prices go up, what kind of neighborhood can you live in? How does that affect your buying power and where you're going, right? So in January 2021, we updated that, and those rates didn't really move as much as we had thought. There were some things that kept those in place. We were actually off by about 5 or 6 months from what happened there. But the buy now in January 21, we did the same deal, and the purchasing power there to keep the same rate and payment, right, at where you were in April. So we did this in April. So at 275 was in January, but when I did this in April, that's when we moved up. So I said we were about 4 or 5 months off of what we thought. And then it was 320. That same house that was 300 is now 320. That was back in April 2021. The rates were up, and of course that'd be your payment. And to keep that same payment based on our expectations, then in that December of that year, you would lose only about $20,000 in buying power, right? So now we are seeing that now I want to kind of give you an update of what the buying power you may lose now, because that was a little smaller buying power that you'd lose, but the bigger deal was that the real prices of that same home, that $300,000 home in January 2021, went up to $360,000, right? And you could only, to keep the same payment, really have about a $300,000 purchase. So that's big delta. $60,000's a lot, right? And so we did it again in March, but it changed so much since March, right? It was 375 in January 2022, around 4 1/8 in April. We were expecting in December to move up to about 5.25, but then the inflation news just came cratering in, and I've updated this now from just a couple months ago. I don't usually do that, but I want to show you the one now because rates have moved that much, as everyone knows. Buy in January of 2022, those were the rates then. In May, now they're around 5.5. We just showed you that. By the end of September, because of what happened last summer, where rates are going and prices are going, it is expected that same $400,000 home now, remember, we're using the same type of home that was $300,000 last year, is now $360. It was $360 at the beginning of this year, is now roughly $395. By the end of September, it'll probably be $450. And then the rates are estimated to be somewhere around 6.25 to 6.5%. And so that same home that you're trying to buy now could cost you about $700 more a month. That's a lot. We know that, okay? To keep the same payment as today, you'd be buying around a $370,000 home. Now, there are some options. Adjustable rate mortgages, ARMs, fixed for 5 or 7 years, are starting to come back for certain profiles. They have tighter credit profiles or restrictions to help them make sense, but they are there. And so we will look at those for you as well if that's something you're interested in. Those are good opportunities to do in higher rate environments like this. And hopefully, we're incorrect, on some of these, but we do want to let you know that obviously never rush into a purchase. If it doesn't make sense, it doesn't make sense. But also don't dawdle. If you want a home, go get aggressive. We want to help you get aggressive for that because the buying power, it can be drastically reduced, and we don't want you having to settle for a home in a neighborhood that you don't want to live in. So I hope this is informative for you. I showed you the ones before so you could see we've been tracking this for years, and we've been off by a few months, but we've been right on where the rates are going, right on what actually happens. And so hopefully there's a little bit of delay in this, and this doesn't happen until December. And but we want to make sure you're armed with those decisions, with this information, so you can make good decisions. If you got any questions, we're just a phone call away if you need us, or an email, or a text. And again, we're fighting for you in the trenches every day, looking for better programs, looking for ways to help you be competitive and win the deal and have a great experience. Have a great week. Take care.